Japanese candlestick charts are a remarkable tool for traders. They originated in Japan centuries ago. Rice merchants first used them to track rice prices. These charts offer a visual way to understand price movements. They show the battle between buyers and sellers very clearly. Many traders around the world now rely on these charts. They provide more information than simple line charts. Learning to read them can give you a real edge in the markets. This guide will help you understand them step by step. Candlestick charts have become incredibly popular for good reasons. Their visual nature makes them easy to grasp quickly. Each candle tells a story about the trading period it represents. You can see the strength of buyers or sellers at a glance. This immediate insight is very valuable in fast-moving markets. Unlike bar charts, which can look cluttered, candlesticks are clean. They highlight the relationship between the open and closed price effectively. This makes spotting potential trends and reversals much simpler for the trained eye. Their intuitive design is a big part of their enduring appeal. By the end, you should feel more confident looking at a candlestick chart. Each candlestick on a chart represents price action over a specific time period. This period could be 1 minute, 1 hour, 1 day, or even 1 week. So, a daily chart will have 1 candle for each trading day. An hourly chart will have 1 candle for each hour of trading. Understanding this time frame is the first step. Each candle, no matter the time frame it covers, provides 4 key pieces of price information. These 4 prices are fundamental to interpreting the candle's message. They are the open, the high, the low, and the close. Let's start with the open price. The open is the first price at which an asset traded during that specific time period. For a daily candle, this would be the price at the start of the trading day. For an hourly candle, it's the price at the beginning of that hour. The open price sets the initial tone for the period. It is a reference point against which other price movements are measured. Knowing where the price started is crucial for understanding the subsequent battle between buyers and sellers. It is one end of the candle's real body. Next, we have the high and low prices. The main part of a candlestick is called the real body. This rectangular section is key to understanding the candle's message. The real body represents the range between the open price and the close price for the period. If the close is higher than the open, the body is usually one color. If the close is lower than the open, the body is a different color. The length of this real body is very significant. A long body indicates strong buying or selling pressure. A short body suggests little price movement or indecision in the market. A bullish candle forms when the closing price is higher than the opening price. This means that during the period, buyers were in control. They managed to push the price up from its opening level. Bullish candles are often colored green or white, but we will discuss colors later. The psychology behind a bullish candle is positive sentiment. It suggests optimism and buying interest in the asset. The longer the bullish body, the stronger the buying pressure was. This can be a signal of continued upward movement, especially if part of a larger pattern. Conversely, a bearish candle forms when the closing price is lower than the opening price. This indicates that sellers dominated the trading period. Section 4. Painting the picture colors and their meanings. Color is a powerful visual aid in candlestick charting. It allows traders to quickly assess the market's direction for a given period. Most charting platforms use a default color scheme. However, these colors can usually be customized to your preference. The key is consistency. Once you choose your colors, stick with them. This will help your brain process the information rapidly. The standard convention is to use one color for up candles or bullish candles, and another for down candles or bearish candles. This makes the chart easy to read at a glance. For bullish candles, where the close is higher than the open, common colors are green or white. Green is very popular, evoking images of growth and profit. White was traditionally used in early black and white charting. Some traders still prefer white for its clean look. When you see a green or white candle, it immediately tells you that buyers won the session. The price ended higher than it began. This visual cue is much faster than comparing open and close numbers on a bar chart. Section 5. Reading the shapes, long, short, and what they tell us. Beyond the color, the overall shape of a candlestick provides deep insights. The length of the real body is particularly important. We've touched on this, but let's delve deeper. Long-bodied candles signify strong conviction from either buyers or sellers. Short-bodied candles, conversely, often indicate indecision or a period of consolidation. The wicks, or shadows, also play a crucial role in interpreting the candle's story. Their length relative to the body can reveal a lot about the struggle that took place during the trading period. Consider a long green or white bullish candle. This candle has a long real body and often but not always short wicks. It shows that the price opened near its low for the period. Then buyers stepped in decisively and pushed the price significantly higher. The close was near the high of the period. This type of candle indicates strong buying pressure throughout the session. A green Marubozu is an extreme example. It has no wicks at all, meaning the open was the low and the close was the high. This is a very strong bullish signal. Now, think about a long red or black bearish candle. Section 6. Spotting the clues. Essential candlestick patterns. Individual candlesticks provide valuable information. However, their predictive power increases significantly when they form patterns. Candlestick patterns consist of one or more candles. These patterns can signal potential reversals of a trend or continuation of a trend. Learning to recognize these patterns is a key skill for a candlestick trader. Remember, no pattern works all the time. They are indicators of probability, not certainty. Always consider the context in which a pattern appears, such as the prevailing trend. One important group of patterns signals indecision or a potential reversal. The doji is a classic example. A doji occurs when the open and close prices are virtually identical, or very close. This results in a very small or non-existent real body, looking like a cross or plus sign. A doji indicates a balance of power between buyers and sellers. After a long uptrend, a doji can signal that buying momentum is fading. After a downtrend, it can suggest selling pressure is diminishing. Variations include the long-legged doji, dragonfly doji, and gravestone doji, each with subtle nuances. Section 7. From charts to choices, making informed trading decisions. Mastering candlestick charts is a journey, not a destination. These charts are a powerful tool, but they are not a crystal ball. They provide clues about market psychology and potential price movements. However, relying solely on candlestick patterns without other confirmations can be risky. Successful traders use candlesticks as part of a broader trading plan. This plan should include other forms of analysis and robust risk management. Never forget that the market can be unpredictable. To increase the reliability of candlestick signals, combine them with other technical indicators. For example, if you see a bullish reversal pattern like a hammer, check the trading volume. High volume on the hammer candle can strengthen the signal. Consider using trend lines or moving averages. A bullish pattern appearing near a key support level or a rising trend line is more significant. Similarly, a bearish pattern at a resistance level or a falling trend line carries more weight. This confluence of signals improves your odds. The context in which a candlestick pattern appears is critically important. A hammer pattern might be a strong buy signal at the end of a long downtrend. Don't forget to comment, like, share, and subscribe. Until next time, keep learning.